Hey everyone, welcome back to the Canela Show. It is your host, Priscilla. In this video, we're going to be talking about how to invest for beginners. This is a video that you want to watch if you're new and just starting off, or if you're confused, or even second guessing yourself and you don't know what to do, or if you don't even know that if this is the thing that you should be doing. At the end of the day, most people want the same thing when it comes down to investing. Everyone has a common goal amongst thousands of investors, and that is that they want financial independence. They also want less financial stress, and they want something to retire. So that's the ultimate goal. You want to have your money work for you and also have it grow over time, so that you don't have to work so hard at your day job. So in this video, I want to lay out how you can get to this goal and some tips that you can use. We're going to be talking about some basic principles about investing, what you're actually doing when you're buying a stock or an ETF. We'll also be talking about brokerages, well, mainly the one that I'm using, portfolio construction, and pretty much just the basics that you need to get started. So I believe that this is a video that'll be great for anyone that is just starting out, that is new, or maybe you just want to reassess your strategy. So I want to give a quick introduction about myself again, in case those that are new haven't seen my previous video. But my name is Priscilla Canela. I am 29 years old. I first started my investing journey about a year ago, back in November of 2023. And around the same time, I started a YouTube channel sharing my journey and a bunch of things that I am learning and that I am doing along the way. When I first started, I was a bit inconsistent, but in the last few months, I have decided to dive a little bit deeper and give this my all. And right now, within the last 2 months or so, I have almost 500 subscribers, and my videos are getting more and more views. I have also started to show and will continue to show my portfolio, the performance, how it's doing, its ups and its downs, what's not working, what it is that I'm investing in, what are my goals and my earnings, and you'll also be able to see my growth over time. So, taking a look at my portfolio, my primary investment account is a non-registered account, which is a tax-free, a not tax deferred from the government. My mouse is not working. I have to get a new mouse because this thing decides to work whenever it wants to. Okay, so you can see here that the current value of my portfolio is $3,317.52. And it currently has $96.89 in gains. So this may not seem like a lot from when I first started. However, I'm very proud of myself and where I'm at in this journey this far. And that's because I haven't had a lot of money, honestly, to be investing. But because I'm invested in this and learning more and want to continue to do this long term, I've stopped making excuses and just started with what I have. Because at the end of the day, I also want to show other people that you don't need to have a lot of money to be doing this. You don't need to have a lot of money to be investing. And the thing is, a lot of people think that they do, and that's why a lot of people skip out on doing it, they avoid it, or they push it to the side, or they waste time waiting around until they get to a specific amount to be able to invest. And by doing so, you're honestly just wasting time. So with that being said, I just started with what I had and what I'm able to contribute with. And obviously, whenever I get the opportunity and have more money, I will be contributing more. My mouse. I keep going for my mouse and it doesn't work. Okay. A lot of the companies that I have are a mix of ETFs, individual stocks such as high dividend, growth stocks, and dividend income stocks, I've been mainly focusing on diversifying my account. And because I said I don't have a lot of money, my main focus has been companies that do pay out dividends. And my plan is to hold them for as long as I possibly can, so that whenever I do get paid from these companies, I can use this toward expenses. So let's get into what is investing and what a brokerage is. So what you're looking at right now is the Wealthsimple. It has an app, it has a website. I'm using the Wealthsimple broker. If you're in Canada, this is my top pick. I do have a lot of followers on here that are from the United States, so unfortunately this is not one that you can use there, but there are a lot of companies out there that have similar concepts, and some of the ones that I've heard of in the United States that a lot of people really like are M1 and Robinhood. So those are ones that I suggest that if you're from the States, you can use those. So brokerage does exactly what the name implies. A brokerage transaction. That's basically how you have to think of a brokerage. The brokerage doesn't hold your money and they don't hold your securities. They just brokerage your transactions. So for example, if you look at a realtor, you have a buyer on one side and then you have a seller on one side. And then you have the realtor that's in the middle, brokeraging that transaction. And that's exactly what Wealthsimple does. So whenever it is that I want to buy a stock, I'll go into Wealthsimple and I'll use them to buy my stock, and that's how I'm able to look at my returns as well. I'm also able to look at the companies that I own and how well they're doing. That's all that a brokerage is, really. And also, before I continue, I've placed a link in my bio for anyone that is new and doesn't have a brokerage account. If you would like to use Wealthsimple, if you are in Canada, just click that link and use my coupon code. That will get you your first $25 towards your investment. For this video, the brokerage that I will be using is Wealthsimple. But before diving more into that, I want to talk a little bit about risk. I believe that this is something that everybody should know when they're investing, because there is a downside to investing, and that's the scary part to investing. So when you are investing, you are putting your money at risk. You do have a chance at losing money. There's a chance that the stock will go down. There's a chance that the stock will never recover. The market can go down and you can lose money. But over time, there's all this information that shows that the market typically continues to go up, even though there's a lot of dips in between. However, the chance remains that there's a possibility that you can be losing money. And that is why it's called risk. So risk is broken down into two different categories. And then this is just from like a fundamental investing standpoint. Have something that's called systematic risk and unsystematic risk. Systematic risk, types that are completely unavoidable. So it doesn't matter like what you're investing in, you're going to have systematic risk whether you like it or not. So the only way to avoid systematic risk is literally by not investing at all. It's something that you literally cannot avoid. This is like a type of risk like the coronavirus, which completely came out of nowhere. And it crumpled like the US economy, and we had like 20 million people out of jobs. So this is a perfect example of a risk that you cannot avoid. If you're investing in anything as an investor, this is something that you have to know, and this is something that you have to deal with. We also have risks of a recession, like the Federal Reserves and their policies, like interest rates and different things that we can't control, and then also the risk of unemployment. These are all examples of global events. There's definitely a few more that I could list, like an example of war. World War III would be another risk that we would potentially have to deal with. And then you have another risk that's unsystematic risk. And this is also known as undiversifiable risk or specific risk, meaning that these are reasons to get away from these risks because these are all things that are specific to investing in these certain companies. For example, let's say I invest in a specific company like Apple. They're a great company. Maybe they'll do well in the future, but there's still specific risks that are associated with investing in Apple that may not exist in other companies. For example, it manufactures its phones in China, and that is a risk to Apple because maybe there's a company that doesn't manufacture its companies in China, like Visa. Visa and Apple have different risks. One of them is dealing with China, and the other one is not dealing with China. That is just a specific risk to Apple. And then this is something that you can get away with by not having this specific exposure to Apple. And then they also have other risks, like a phone that they come out with can be a total flop. They have the Bendgate 2.0 or just another phone that's completely terrible. And then Samsung takes huge market share and then the stock of Apple goes down. These are all examples of risks that you can get away from, unlike the overall economy. That's just something that we simply can't avoid. With these risks, you can get away from management decisions, competitors, fraud, and all these different things that can happen with companies and the way they get around them. And the way to get around them is diversification. That's how you get rid of unsystematic risk. So there's a tool that helps us diversify the market, and that's called an ETF. Some of our parents may have used the term mutual fund, or maybe you have even heard the term mutual fund. And it's pretty much the ETF of their day. But an ETF is so much more better. They're also cheaper to use and they're more liquid, meaning that you can buy or sell at whatever time that you want and they're just more available. So another way to put it, to avoid unsystematic risk is not to put all your eggs in one basket, which is not putting all your eggs into individual stocks and focusing on ETFs, which will automatically diversify for you. So this is good for when you're just starting off and maybe you still don't know about individual companies, you don't know how well they're doing, you haven't taken the time to do your research, and you just simply don't know much about it. Starting off with ETFs for the time being is an amazing way to start off. Another example of something that is great to start off with is the S&P 500. The S&P 500 is essentially a basket filled with the top best 500 companies in the United States. Meaning, whenever you invest into it, you're investing into its companies. So when I click onto the S&P 500, I then have its portfolio. And if this is all that you wanted to invest in, you are easily investing into a portion of the best 500 companies in the United States. And that's still great, and you'll automatically be diversified. Basically, it automatically moves out the companies that aren't doing well and moves in companies that are doing well. So then you don't have to worry about that. You can literally buy and hold this for like the next 20 years and it'll probably still be doing okay. And this is the advice that Warren Buffett gave. Let's just say that you have a high percentage in there, but then there's also other industries that you believe that are doing well and will continue to do well, such as the tech sector or the financial sector. And you want to have additional exposure to that because you believe that in the next 5 years, they will continue to grow. So what you can do here is find individual stocks in the tech sector, such as Microsoft, Apple, or in the finance industry, you have Visa, you have MasterCard, companies like that. But keep in mind, these come with risks because we don't really know how well this company is going to do. We don't know what the future has for these companies and how well they're going to continue to do. The only thing that we know is how they've been doing in the past and how well they've been doing the last 5 years, last 25 years, etc. Because of that, we believe that they are going to continue to do so. So it's pretty much just putting your faith into this company based on the information that you know in the past. Another way to find an ETF in whatever industry or whatever sector that it is that you possibly have in mind that you want to look into is using a website called etfdb.com, and we're going to click on the ETF screener. And if you click on the left-hand side on equity, we can go down to the sectors and you're able to choose the one you are looking for and browse through different ones. There's automotive, there's gaming, retail, consumer goods, energy, financials, healthcare, materials, and then we have tech. Let's click on tech and take a look at that. So here you have the different ETFs. Here are the ticker symbols. So for example, QQQ. And then let me click on this one. For example, VGT, that's Vanguard. Information technology. And then if we go to holdings, we can see all of the companies within this ETF. So we see Apple, we see Microsoft, Nvidia, and if we scroll down, we see a few more as well. And then we can go back to the stock profile and price. So basically gives you a bit more information on this ETF. So VGT Vanguard tracks a broad index of companies in the information technology sector, which the company considers to be the following three areas: software, consulting, and hardware. As a result, this fund tracks some of the most crucial companies in the technology sector across a wide range of market cap levels. The fund focuses entirely on US stocks and is relatively top heavy. Three securities make up 20% of the fund, 54% of assets go to the top 10, even though the fund holds over 425 securities in total. Investors should also note that this fund dedicates the majority of its assets to giant and large cap funds, meaning that it will be less volatile than some of the other products in the space that focus on relatively unproven companies and technologies. As a result, this fund will be more of a value pay than one that presents strong growth opportunities. So while this is a decent fund for those looking to achieve broad exposure to the tech sector without the influence of semiconductors, most investors should look to broader funds which take into account of all sectors of the technology industry instead of their portfolios. So this is a great website to be using because, as you see, it gives information on the different types of ETFs. It lets you know its expense ratio. It lets you know all of the holdings that are in that, their expense ratio, and their fees. Then we have dividend and valuation. So we have that here. Annual dividend yield, the percentage there. So you have quite a bit of information here. So this is where you can go instead of selecting individuals. Like we see that this company holds Apple and Microsoft. So instead of selecting Apple on its own or Microsoft on its own, you can find companies and ETFs that hold them. And there we can take a look at another one. Okay, at the top we have QQQ. That's an ETF that I have. You can take a look at it and see. At the top you can see their price, you can see their change. Again, you can see its holdings have Apple as well and Microsoft. The NVDA, the one that I just mentioned, you see Amazon, you see Tesla, you have Costco, Google, Netflix, Pepsi, So with my portfolio, I do have quite a bit of these companies individually, as I know it's a risk. And then I also have ETFs that hold all these companies as well. So I want to go back to my portfolio. And now that I showed you guys and explained to you guys the risk of investing, and you know that ETFs are a bit less of a risk than buying into individual stocks, I do have a video, you know, going over all the stocks and stuff that I own, but I can briefly take you guys through some of the ones and show you. Apple, Amazon, those are individual. Apple is an ETF. ATD, Costco, Google, Home Depot, those are all individual. I have other ETFs. Then I have Johnson & Johnson, another one. MasterCard, MSFO, Microsoft, NE, NVDY, another ETF. Realty Income, O, QDTE, QQQ, QQY. So I have, you can see that the companies that I own are in multiple different sectors. Like I have real estate, I have finance, I have tech. There's TD, Tesla, Visa, Waste Management, Walmart. So these were just companies that I've done kind of like my own research, and I know that these companies have done well over the years and have, you know, growth, 5-year growth potential as well. That's kind of, you know, where I started, and I'm like, okay, MasterCard. I was just thinking of some well-known companies that I know that are doing great. Microsoft, we know that. You know, Amazon, Google. These are some of the top companies. Apple. So I want to show you guys essentially how you can start investing. So this is pretty much what your, you know, your page would look like, your account, your portfolio, it would look like. You have home, you have activities. So that's anything that you do, whether that's deposit, whether when you buy a share. I have a lot of activity here of like all the stuff that I buy. I have to shuffle through because I also have, Wealthsimple has their own cash card. So I use that. So as you can see, I have deposits to my cash. But anyways, okay, so for example, yesterday, I just deposited $30. I know it's not a lot, but I decided to put more of a fractional buy into Google. So basically, I'm going to go back to home. Here you can add money. Why is that? Okay, anyway, so that's where you add your money. So you set up your account, you add your bank account, you can do an e-transfer. There's multiple different ways on how to do so, which is nice. So let's just say I have money sitting in my account, so my non-registered account. It shows here that I don't have any cash available because I haven't deposited anything. So, but let's just say that there is some money there, right? So basically yesterday I put in some money and I added more to Google. So I'm going to show you basically how I would do that. So you click on Google. And this is already one that you already have. I'll show you how to start off with a new one, but you can see here, you can do either a share, like a number, like let's say you wanted to buy 1 share or 2 shares into the company. But sometimes 1 share of a company can be a lot. So like, for example, 1 share into Google is 164. Let's say you don't have that money and you don't want to put that amount in there. Let's say, you know, maybe you only want to put $50. Instead of putting the amount of shares, you put 50 and it'll calculate how much of a share you're putting into it. So $50 will give you 0.3038 of a share. and that's fine. And then that's how you would go about doing that. It's not going to let me because obviously I don't have that money, but you would essentially do it that way. So it's nice. And then here where it says search, you can search of a company that you're interested in. Tesla's already there. It's an ETF. You go there, you have all the information on it. It's yield. Here it shows me how much I have, how much shares I have. Right now with them, I have 13 shares. And it shows you your activities with that share. And then if I want to add more, like let's think of a company, Starbucks. I was invested in them, but I decided to sell it because it's a company for personal reasons. I don't want to support this company any longer. So I didn't have a lot invested in them anyways, but because it was a decision that I decided to make, I just sold it and I had extra money and I put that money in something else. So for some people, if they're interested in buying Starbucks, you see how much it is. You can see, how they've been doing over a month period, 3 months, a year, how they've been doing in the last year, and then in the last 5 years. I like to take a look at the 5 years to see overall how they've been doing, how much ups and downs, have they recovered. You want to see that companies go up and down all the time, but you want to see that a company has been steady and there has been some growth within that last 5 years, because that'll play a role into the company in the future. That concludes this video. I hope that you learned something from this. If you have any questions regarding anything that I spoke about or anything outside of that, please feel free to leave a comment. Like this video if you haven't already, as well as subscribe, and thank you and stay tuned for more.